Welcome to the Bitcoin Macro War Room, where we jack into the market mainframe and derug the narrative. Plug into the pipes, M2, DXY, inflation, momentum, fresh prints, CPI, ISM, payrolls, rates, truth by facts, not vibes. Tweets and news rundown, meme to policy, curated, timestamped, tradable.
Welcome, you've got mail.
Copium not included. Roll the tape, let's invest like it's 1999, but with better charts.
Welcome back. I hope you have some coffee with you or maybe a nice hot chocolate and you're snuggled up next to some fireplace or your 12 monitor trading setup.
What?
But we're going to get into a ton of charts today like we usually do. I have an update about my personal portfolio that I do want to share.
Oh, here we go again.
Just to keep myself honest. And there's a bunch of data to go over and why I think we should remain cautious up until the end of the year, because there are rumblings. There are things going on with liquidity and obviously the government shutdown, but we'll get into all of that and more. So let's kick it off as we always do with the charts. And I think the most important thing that I wanted to call out here initially is the regime tracker here on the bottom panel. We have been in this upward trend channel since April 19th, 2024, and we, for the first time, have slipped out of it and broken below. I mentioned last week that I was hoping to see this come back up and rebound, but we have actually hit the 50% midline and might see a bounce here, but that is yet to be decided. The main factor driving this drop has been not only the strength in the dollar, but the ISM print coming in lower for manufacturing than the forecast. Also, liquidity hasn't really been supportive. You can see on the top chart here with the global M2, we've just been in this chop zone. We've revisited the 89-day EMA. We have reclaimed it, although slightly. So we haven't had any kind of positive M2 movement here in a while. I would say in probably 2 months, 3 months. This is lagged by a bunch of days. Regardless, the one thing that I did think was interesting though, and sort of gives me more confidence in this tracker on the bottom that I've created, is you can see since the sort of top that we've had in this tracker, you can even maybe go back to about there, the actual price performance in BTC has sort of reflected that, right? And this most recent drop, so if you take it really from the Pico top right about there, the regime tracker has been steadily decreasing. And while we've seen some pumps, we've resolved mainly to the downside. Regardless, this is not a great signal. Hopefully this is the bottom. My underlying thesis hasn't changed for the ISM, but we'll take a look at the data in just a second because this print did not help the case in terms of bullishness. If we take a look at the short-term charts, we've been in a downtrend since these MAs have crossed at the end of October. And besides this one sort of attempt at a breakout, which was quelled fairly quickly, we've just been using this as resistance. So until bulls can actually regain control here and flip these bands green potentially, there could be more downside. And I think that that's probably likely maybe the case, or at least at best, I would expect us to chop in this zone, form a base, and then potentially go higher. You can see the original Elliott wave target was hit and it was actually breached a couple of times here. So the most important level to me right now is 98.3, 98,300. If we break below this, you could almost say look out below because things could get really nasty really quick. And I'm hoping that doesn't happen, but we'll see how the price action kind of pans out. The one chart that I did want to show, which is just again to zoom out, is the long-term composite down here for the DXY plus the ISM. This has flipped bullish, although you can see that the performance has been muted, and so has kind of this cycle. Yes, we have had a 5x off the lows, but it's taken us pretty much 3 years to get there. How much more room do we have to run? That'll all depend on sort of some of the liquidity catalysts, which we'll get into in my notes for 2026, but I still remain cautious into the end of the year because there are a bunch of signals about stocks potentially rolling over. And given that stocks are a risk on, risk off type of asset, a high beta asset in terms of everything else you can invest in, Bitcoin usually follows it. So regardless, let's take a look at some of the data really quick. So the main release here that was the most important and that was the most disappointing for me was the manufacturing PMI. This had a pretty large miss, 48.7 versus a 49.4 forecast. And this forecast would have, if it was hit, continued the sort of uptrend towards 50, towards expansion. But now we've dipped back down. Could this be just a temporary sort of down data point as a miss? Potentially, but it's not great.
Sometimes it may be good, sometimes it may be
Prices came in lower, which is fine. The only positive here was the services PMI, which is again the biggest chunk, did beat substantially by 2 points. So this is good. But as you can see here on the actual chart, it has been in this sort of range since May of 2023. We haven't had a sustained uptrend. We've just been kind of chopping between 50 and 55 with no actual breakouts. So I'll take this print with a grain of salt. And also consumer sentiment is in the dumps. So we had a 50.3 versus a 53 forecast. And I think next week will be important too. We have a bunch of inflation numbers around the CPI, unemployment claims, PPI, and retail sales. So some more data to look at next week, but underwhelming to say the least in terms of the PMIs. I really did not expect this print to be 48.7, but it is what it is. We'll take a look at the Fedwatch really quick. And to be quite honest with you, not much has changed here. I think we were at 65 or 68% last week. So for December, the last potential cut for this year, we're now at a 70-30. We'll continue to monitor this and see how it changes, but it hasn't really changed much since last week except going up a few points. So that really doesn't mean too much at this point to me. Again, I've kept these notes in here from 4 weeks ago and I continue to harp on this, but stock market, this is the most important one to me. And this is one of the reasons I did a change in my portfolio today. And I'll actually speak on that really quick before we talk about this, which is that I mentioned last week or maybe in the video the week before that I was looking to add some leveraged long calls for IBIT for June 2026 at around 103,000. And I did that. So right about in this area is where I started my purchase of IBIT calls with a decent chunk of my portfolio. I have now sold those off. I do not think the current risk to reward is there. And there are some Elliott wave analyses that I really can't share, but let's just say that if we do break the 98K level, we could see a lot lower prices before continuing the uptrend. And the reason that that gives me pause and sort of caution is because of this. You're starting to kind of see this today with the stock market sort of rolling over, especially tech. And I will share something from the research reports that I paid for that I can't really show what the numbers are, but let's just say the TLDR here is that red is bad. And these are basically positioning indicators. Historically, when 4 or 5 of them are firing, that means you are likely near a local market top. As you can see here, we have 7 out of all the indicators firing.
No, God, please, no, no, no.
I've actually never seen this many. I think the last time we had a peak, there were 6 of these signaling. So that gives me a ton of caution and a ton of pause in terms of reducing my leverage and actually reducing my spot risk as well. Now, let me clarify there because I do have Bitcoin spot bags that I hold in cold storage that I will not touch no matter what until like 2030. That is my long-term spot bag. I will be using that to accumulate. But for my actively managed portfolio, I also do have spot via ETFs, and I have reduced that position as well today. Do your own research. This isn't financial advice. This is just what I'm doing because currently, to me, the risks here, especially with stocks potentially rolling over, that would have an even greater impact, in my opinion, on a higher beta asset like Bitcoin. So regardless, some bullish arguments, a bullish side to this thesis is that there are numerous liquidity positive events happening within the next 4 to 5 months. So for November, this is a big if, but if the government shutdown gets resolved, we should be seeing the TGA being spent down. I mentioned this last week, but you could see the chart here, and the TGA is basically at $1 trillion. This is liquidity tightening. It means it's not in the system, and it's because of the government shutdown. If we do get this resolved, they'll spend down the cash pile, and it could push at least a quarter of it by the end of January, but that's a long time. That's 2.5 months away. And my issue is, if you take a look at the poly market odds, which are generally really good for this, the government shutdown is not slated to really end anytime soon. I mean, there's a 25% chance it'll end of next week, 12th to the 15th, but there's a almost 60% chance that who knows when it's going to end. It might not end till December for all we know. So that is definitely a huge risk still in my mind. And pinning all your bags and hopes and dreams on the Fed spending down the TGA and that injecting enough liquidity to sort of pump risk assets, that's not something I want to be holding the bag for, potentially. Another reason why I've reduced some risk today. For December, they've said this already. Powell said this at the last FOMC speech, even though he was hawkish about cuts. He did say they're going to stop the balance sheet runoff, meaning that they're going to remove the drain of $60 billion a month. I've seen some other numbers where it's 40 billion, whatever, it doesn't matter. The fact that they're stopping the runoff is a positive for liquidity. For December, we have reserve management buys, which is basically to keep short-term funding smooth. The Fed may add around $500 billion to the balance sheet over 12 months. So that's not immediately, it's over 12 months. For the shrinking, again, that's a per month drip. And for the TGA, same thing. It's going to be a slow drip. It's not just going to be automatic. They're going to inject $1 trillion overnight. As soon as the government reopens, it doesn't work like that. It also takes liquidity time to cycle through the system and actually affect risk assets. So regardless, Q1 2026, they're going to continue to sell short-term bills. That should boost bank revenues. That should add another sort of $250 billion of liquidity potentially. These are just the things we know about and that they've kind of hinted at. My other issue is that will they actually pull the trigger on this? I'm assuming yes at this point, but I'm taking a more defensive stance. So regardless, with my notes out of the way, let's take a look at the system because boy, do we have some updates. And if this is what you're here for, well, we're going to break it down. Again, the top 3 rows here are paid institutional research that I composite into a score. Basically, are they bullish? Are they bearish? Are they neutral? That is the core, the backbone, the spine of this system. And then I have some additional inputs that I run myself. But the 2 biggest call outs are the macro regime tracker, which I just showed you is basically flirting with the 50 line. When I updated this last night, it was at 50. So I marked this as bearish because I'd rather be on the side of caution. And one of the institutional inputs that I use has, for the first time since I started this show, flipped bearish. Now, it is the lightest weight in terms of all the other indicators, but I think it's important to note that there are signs, there are issues happening under the surface. So this gives us a current score of 60, the lowest score since I started the show. I think the lowest ever reading thus far in the 20 or so episodes that I've done this has been, I think, 75 or 78. Now, really, what you should be doing is thanking me because I'm probably selling the bottom and we're going to rip from here. And if we do and everything stabilizes and starts to turn positive again, I will get back in, no problem. I'd rather take a short-term loss, as I did on these call options of about 10,000 or so, than suffer a potentially $30,000, $40,000 drawdown. One of my main drivers in terms of portfolio management is survival and capital preservation. I want to be able to use my money to fight another day when the odds are in my favor. So if I have to take a loss now to potentially prevent a huge negative, I'll take those chances, even if it could be painful. So you're welcome. This is probably the bottom. I hope it is. We'll see. So that's the system, 60%. Let's take a look at some of the on-chain inputs. DXY, obviously, this indicator is not going to go risk off for a while, but there has been positive dollar performance, which I think has been hampering some of the price in terms of Bitcoin specifically. For the bull bear market indicator, again, this is still risk off. Nothing's changed there. For the STH, same thing. Nothing has changed here. We're still under the STH. We're still risk off. This was the most eye-opening to me. This is a very simple indicator, but it's very powerful. You can see it has been green since the beginning of this cycle. But if you zoom in here, and one of my issues right now is the 365-day MA has acted as a final line in the sand, a final line of support. Well, we recently closed under that line for the first time this cycle. Kind of scary, but you can see it here. Can we bounce and just rip from here? Sure, but you can see that the trend is negative, and that is not a good sign. I hope that we do reclaim this and sort of continue on our merry way into 2026. But I think you can kind of tell by now the sort of stars are aligning in my mind to be a little bit cautious, a little bit defensive here, reduce some risk just in case. If we do end up chopping around for a little bit, building a base, pushing higher, or just reversing straight from here, awesome. I'll get back in with the cash that I have. But until then, I'm going to take a more systemized approach. And I do want to call this out because I know I mentioned this last week and I think maybe the week before. But one thing I didn't mention, which I should have, so this is totally my miss, is that this is a great indicator for catching local bottoms. The thing to note here, though, is that you can spend a month in this green accumulation zone before you actually resolve to the upside. So you can see the last one during the tariff collapse. This ended up staying green for about almost 2 months. So same thing here. This was about, I think, 2.5 months back in 2021, July. And it's important to note that this is a long chart in terms of the x-axis and that it's not going to just immediately mean that we've bottomed. So other than that, the Sharpe ratio is turning down a little bit. There wasn't too many other sort of signals. The Nupal for the first time in a long time has went from yellow to green. And you could see previously that did mark a bottom. So hopefully we are getting towards a bottom here in terms of BTC, but I still remain cautious. This can be green for a lot longer than you might want or might expect. And I do want to talk about the 4-year cycle theory that I've been sort of poo-pooing on for the last couple of weeks, because there is some market psychology to talk about in regards to that. You can see long-term holders, OGs, whales are still dumping. Retail is still buying the dips. You generally want to see the inverse. And other than that, nothing really to talk about here. We can take a look at the liquidation heat maps, and then I'll talk about my 4-year cycle thing. So again, you can see people sort of longing the bottom. This is the 24-hour. I don't really care about this. The 2-week has been completely cleared out. So that's a good sign, although there are some longs forming here on the bottom range. I think what was most interesting here is if you zoom out to a year. So the longest that you can zoom out to, there's not a lot above the current price, right? Which is fine. But my issue here is that there are some distinct patches of liquidations, especially around 92. And I don't know if fearmonger, this doesn't mean they're going to get hit, doesn't mean any of that, but it's just something to note, something to be cautious about. You can see from the April lows here, especially in May, right before we went up to 100,000, a lot of longs were established in this zone. So something to note there as well. Again, this is the stock market positioning indicator, a lot of red on the screen. So not good, and gives me pause in terms of holding any kind of leverage at this point. For the 4-year cycle thing, I did want to talk about something. While I don't believe in the 4-year cycle, I think it just aligns neatly with the global debt refinancing cycle and the global financial crisis. There is some merit to it, and I'll explain what I mean by that. There is some merit to it in terms of if everyone is thinking it and they're all selling their bags because of it, the herd mentality, so to speak, that will create selling pressure no matter what. If everybody believes in the 4-year cycle is over and you have a couple of outliers that don't, it's us versus them. It's a lot of selling pressure versus a couple of people on the fringes trying to buy. So there is almost a self-fulfilling prophecy in terms of the 4-year cycle. And we're potentially running into that now in terms of OGs selling and distributing, because I did want to show this chart, which has been making the rounds on X. I forget who originally posted it, but you can see basically all the yellow and red for the past year has been OGs, whales, dumping, meaning people with balances over 100 million or over 1 to 2 billion have been exiting. And you can see in past cycles, they're usually just exiting the tops. And so they've been exiting all throughout basically 70 to 120K. The issue I have with this is, when does it end? When do they run out of ammo to sell? That is really when hopefully the next inflection point will happen. Either that or the liquidity will start to increase. One or the other has to break in order for us to continue appreciation. Also, for people that are in since 17,000, they've already made their bags. I harped on this last week, but what's the point of holding for another 20, 30K when you're already up 5X? You can just secure those gains. Another issue is that people have been generally obliterated in alts this cycle, meaning we've had some like mini alt seasons, certain names have run, but alts as a whole have underperformed, haven't done well. A lot of people generally shy away from Bitcoin, especially retail, because of big number bad. I can't afford 100,000. So they go down into stuff like Pepe and Dogecoin because, unit of account type of stuff, and they've gotten their asses handed to them. So all the altcoin season, all the highly speculative stuff has really taken a nosedive in terms of sentiment. You see people quitting crypto completely. In my opinion, I think we could still have an alt season. We really need small caps to run. We really need the Fed to continue to cut, but that'll happen over time. It's not going to be overnight. It might be next year. And so until then, what do you do? And what are those people doing? Are they buying the Bitcoin dip? Maybe, but not likely. So there's all these factors sort of going on. And that's why I've had to shift my bullish stance. And the other thing is price action is honestly, it's king, right? And when you have sort of the NASDAQ, this chart's a little bit outdated, so this would actually be a little bit lower on both ends, but it gives you the same idea. Since the beginning of the year, NASDAQ has outperformed. If you were in tech or AI or even quantum, you're up 10, 15, 30%, while Bitcoin, you might be down 10%, depending on where you bought. So it's just left a sour taste in people's mouth. The sentiment is in the gutter. Usually that's a reversal signal, but given all the other stuff going on, the liquidity air pocket, the government being shut down, the 4-year cycle, all of these things amalgamating together, it's honestly a kind of a strength in itself that we're still above 100K. So regardless, for 2026, I'm still very bullish, but in the short term, I am advising caution. We are definitely in late cycle. If I had, completely been starting from zero right now, would I be buying? Probably not yet. I might start a really slow DCA. And you see that here also for the fear and greed. We have a reading of 21. And I wouldn't be shocked if this goes absolutely longer, maybe for a month, where we sort of sit in a zone like we have before. This doesn't immediately reverse to the upside. Price action has to follow. For Julius, I shared some of his stuff last week. I love his model. It's been sort of spot on, but you can see he cut it off in January 2023. But if you zoom out a little bit more, there's been other instances of this where we've hit -2 standard deviations, which is the bottom end of the range, and have bounced, and we're basically starting to be in that zone. But if you really look at this chart closely, which I'll show right now, you can see that the bottom end, the max pain -2 standard deviations, is actually around 80,000. So quite a significant drop from here. It's another 20%. Playing devil's advocate, even in my mind, not to like turbo bear myself, but let's say that does happen like it did here, right? Where we test sort of even the middle of this. That means we're looking at 90K. If we test a lower bound, we're looking at 80K. I definitely don't want to be holding long IBIT calls on a dump to 80,000. My entire premium would basically vanish in an instant. So just playing some defense here at this point. You can see the trend here is still up. And if we do have a violent snapback to what the fair value is here, we should be at 150K. It's just that there's things keeping us ballooned underwater at the moment, and something's got to give. So regardless, I will leave you with this, the positioning model. Again, my kind of short-term thesis is that there are some warning signs in stocks, in SPY, in NASDAQ. Whether you like it or not, they are correlated with Bitcoin and liquidity as a whole. Could we be at a short-term bottom? I hope so, but I'm also preparing for the worst just in case and doing some portfolio management, switching to a defensive stance when I think it's warranted. Do I wish I switched defensive at 125,000? Of course, but we're not going to be perfect. This is not a perfect game. No one is right all the time. My one right move at that point was selling some calls against my position to hedge. Looking back 2020, obviously, that would have been a great time to add some shorts just as a hedge, not turning short, just adding some shorts. And if I did that, I probably wouldn't actually be selling any sort of spot at this point, or actually decreasing my call leverage as opposed to completely dumping it at a loss. So regardless, another learning experience. And I think that's all you can really do in investing is every week you show up, you sharpen your knives, no matter what's happening, no matter if your portfolio is down or up, you try and take an unbiased stance. That's all we can really do as investors. Try to get better week in and week out. Regardless, if you made it with me this far, thank you so much for watching. As always, I appreciate it. Next week should definitely be interesting. If you did like the video, you know what to do. Not even going to ask you for it. I appreciate you sticking it out with me. And as always, have a great weekend. I will see you next week. Cheers.